One of the most transformative changes to the corporate US tax code in decades. The Tax Cuts and Jobs Act was signed into law on December 22nd, 2017. A reduction in tax rates, a one-time tax on earnings currently held overseas, and a shift away from deferred taxation are all likely to result in an influx of cash back to US corporate headquarters. These changes have implications for technology, media, and telecom companies that extend far beyond their financial results. In fact, we may soon witness a tectonic shift in how US and non-US headquartered companies build value chains, decide where to do R&D, and where and how to invest.
In this episode of User Friendly, we'll explore these and other implications of the new tax code and discuss what tech, media, and telecom companies should be thinking about as they approach these changes. My guests today from Deloitte are Brian Pinto, Janet Moran, and Jim Nason, tax leaders from our tech, media and entertainment, and telecom industry sectors, respectively. Brian, Janet, Jim, welcome to the show.
Glad to be here.
Thank you.
Thank you for having us.
So let's set the stage. I want to quickly ask each of you to summarize what elements of the new tax rules will have the biggest impacts on your industry sector. Brian, let's start with you. What parts of the tax law will specifically impact tech companies?
I'd start with the headline rate reduction. Going from 35% to 21% is a significant change that will impact some of the decisions that our tech clients make around where they put value. Another change that impacts a lot of our tech clients is a move from a deferral regime where earnings were deferred from U.S. tax until repatriated to what is effectively a full inclusion regime. So other than a small part of the earnings, all the earnings will be subject immediately to U.S. tax, a minimum tax.
And Janet, are there any parts of these changes that will uniquely impact the media and entertainment sector?
Oh, absolutely. I mean, Brian has clearly stated the biggest one is the reduction in the tax rate. Now, media companies historically have actually paid in some of the higher effective tax rates, higher 20s, mid 30s. So to go from, say, 35% down to 21%, 40% reduction is a huge benefit for them. And, if you think about the media companies in the last few years, it's been challenging. They have a lot of fierce competition coming out of Silicon Valley and Seattle. And it's kind of been a difficult time with declining advertising revenues and cord cutting happening and declining pay TV subscriptions. So I think we'll see with the influx of cash, the repatriation that's going to take place. There were a lot of companies parking foreign earnings overseas, and I think they'll bring that back. We'll get to see some M&A activity from that. We'll get to see some R&D spending, hopefully some really cool new content development being done with that dollars back. Paying down debt, giving out bonuses. So really lots of good things for the industry, I think, coming out of this. Also for the media and entertainment industry, there's a new limitation on disallowance of entertainment expenditures as a deduction. So that's a real bah humbug part of the legislation. Also, no more tax-free like-kind exchanges unless you're in the real estate industry. And in media, we've seen like-kind exchanges be used for sports contracts, for FCC licenses. But other than that, I think the rate reduction and having that cash, access to all that cash that was overseas and being able to use that for great things like M&A and investment in R&D.
No doubt. And I'm going to touch upon some of that upside later as well. And clearly it's a real shame for those Hollywood parties that you mentioned. But clearly some challenges ahead for media and entertainment. And then, Jim, same view. In terms of telcos, what are they going to be keeping their eye on?
For telecom specifically, first and foremost, who doesn't love a rate cut? Love a rate cut. There is angst and consternation, but it's really over the implementation and the intricacies of what it means to implement this tax change. But first and foremost, hello 21%. Now, when that euphoria dies down, a couple areas come into focus that are more telecom related. And first is telco above almost all others, is hugely capital intensive. It's a business that's been built on building out networks and built by mergers and acquisitions. So the good with the bad, immediate expensing is monster great for the CapEx that the telcos put into play. And we've had that CapEx forever, but even more so today with the advent, growth, and rollout of 5G. And fifth generation wireless is big, 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 all caps, all underlined, all in bold. Immediate expensing also creates a new lens, as Janet was pointing out, for M&A. So M&A models for large asset buys that are out there, this changes the way we look at an M&A deal. And companies in the telco space, along with media and along with technology, they're trying to figure out what their sweet spot is. And they're going to need to fill out kind of their vertical and horizontal paths to market by adding different segments to their business. And I think that's going to come through M&A. So at the same time as issues associated with immediate expensing, those very same M&A models are going to be significantly impacted by interest limitations. Highly leveraged telecommunications companies that are out there with big debt on their books are going to be facing what the impact of that is, to have that on their books, to reduce those expenses that are deductible, and then at the same time, as they look to take on new companies through an M&A strategy, what will that mean if they have to take out debt to accomplish that M&A? So if I were to predict forward, boy, if I were focused on what to do in this marketplace, it would be M&A modeling, which I think is really the next big thing to watch in this combined TMT industry.
Thank you, Jim, and Janet and Brian for setting that stage. And I want to springboard right off exactly where you went in terms of just some of that impact for the companies that you talked about. And clearly, all three of you touched upon that quite a dramatic drop from 35 to 21%. Janet, that lower corporate tax rate, what does that mean for you, the rest of the audience as consumers? How is that going to permeate through? And what are we going to see differently because of that tax rate?
Well, let's just take a step back. We do have what seems to be a very dramatic drop in the federal corporate rate. However, we have 50 states in the United States alone, and at least 47 of them have a corporate income tax rate. So we're going to have to model out what happens in the states and how much taxes are paid in the states. We also have foreign jurisdictions that, who knows, maybe some foreign jurisdictions will want to compete with the U.S. now, and maybe they'll want to keep their, foreign companies back home, and they'll try to put out some preferential tax treatment. So we really have to do a lot of modeling to see, at the end of the day, and taking into consideration some of these parts of the tax reform. So don't get too excited until we know all of the details. But that being said, I think we'll see companies using that money to pay off debt, to maybe give dividends, share buybacks, and hopefully, as I said, to really increase R&D. Now, this is where I think the consumers could get a little excited. Think about all the cool things that could be done now with this money in terms of R&D, all of the development. You could venture into AR and VR and all kinds of ways of using Internet of Things to get your media and your communications to consumers faster. Do I think that things are going to get cheaper? I think they're going to get cooler, and that's exciting. And then just on another side, a lot of people are getting money back from the IRS this year. And that's going to be exciting because, when a 20-something-year-old has a couple of extra $100, what do you think they do with it? They probably go to the movies. They probably buy movies. They probably increase their subscriptions. And they probably do, media and entertainment type of things with that. So when you think about the overall effect of the tax legislation, both from the corporate and the individual perspective, I think TMT is going to have a really good couple of years.
Some of those benefits of that tax law are clearly going to be beneficial to a number of people, but there is definitely a lot of challenges ahead. Brian, tell me some more about some of those biggest challenges that the tech companies will specifically face in response to the new law.
So when I think about the challenges my clients are in the tech industry are facing, it's centered around their value chain. And so historically, a lot of our tech companies had put their intellectual property offshore, at least the foreign rights to those intangibles, and exploited those in their system outside the U.S. And on a go-forward basis, because earnings, those offshore earnings will be subject to a minimum tax, or what we call the GILTI provisions, as well as some of our outbound R&D payments to support the R&D services, which would be captured by our base erosion and anti-abuse tax. It's forcing a look at our value chains and an analysis as to whether we put value in new places like the US.
Got it. And I'd actually like to kind of dig a bit deeper on that overseas side. So Jim, what are the potential wins and losses for these TMT companies as they face the result of that transition tax on existing overseas profits?
So, Hanish, if you look at this glass half full view, you could have paid 35% to bring these dollars back, but the clients that I'm talking to are not looking at the glass as half full. They're looking at the glass as mainly empty, and the fact that they need to put 10% in terms of a penalty to get this money back into the United States. And I think the tax guys that are looking at their pockets aren't necessarily getting filled with those dollars. It's more an issue that they have to comply with this, document this, fill this out, figure out what it is so that the company can inure to these benefits. So there is an opportunity to bring some cash back based on that foreign investment and to bring that back into the US. But I think Janet already asked the big question, which is, what are they going to do with that newfound money? I know that several of the major companies that are our clients across the TMT space have announced, employee bonuses or some humanitarian gestures with this cash based on overall tax reform. But the question's going to be, where will those big bucks go? And there's been a ton of public discussion on this. If I think of the telco space, could they further invest in the network? That would be awesome. I think the reduction of debt, because that's got the double whammy of, by keeping debt alive on the books and not being able to deduct the interest payments as healthily as in the past, could be a possibility. I think you hear a lot of rumors of stock buybacks by a lot of these companies to, again, tidy up the balance sheet. So from a telecom perspective, as I look at this, I would say the bigger question for me is, what is the right move with the cash? How do you react to this based on a little bit of uncertainty on the horizon, depending on how elections go from a blue and a red perspective?
Thank you, Jim. And actually, just thinking about, like you say, how to use that cash. Brian, a thought around that, and specifically to that point, when we think about these US based multinational tech companies, where do you think they will choose to repatriate that cash and use that cash then?
The first place I'd start is M&A. We see no slowdown in the M&A market. In fact, it's projected over the next 18 months to be at record levels. So I've had a lot of my tech clients that are not historic acquirers. They want to talk about M&A. They want to talk about the impact of reform on M&A. And so there's more and more discussions with both tax and corporate development around strategies to deploy in M&A. So I think that is number one. Janet talked about another one with R&D. I think companies are going to be looking to deploy new technologies and invest in new technologies and make acquisitions around technologies and look for new opportunities to move into new markets. So building factories in new markets or building infrastructure in particular markets. So I think that's where I think a lot of the cash will find a home.
All three of you talked about M&A, and clearly there's a lot of deals happening across tech, media, and telecom right now. So Janet, can you give us an example of how TMT companies should rethink how they restructure and structure their M&A deals?
Well, Jim alluded to this before. I think we probably can expect to see more asset deals because you'll get a stepped up basis in your assets if you do an asset deal, and then of course with these new provisions you can immediately expense some of that. So I think we will see some more asset deals. But it depends on what a buyer and a seller are looking to do. If you're a seller and you want to get rid of all your liabilities, you're going to want to sell your stock. If you're a buyer and you're hoping to avail yourself of some pre-tax reform NOLs, you might want to do a stock deal as well. So it really depends on what buyers and sellers are looking to accomplish. And certainly, I don't think the tax tail will wag the dog in a business deal, But I do think tax will have a bigger seat at the table. I mean, the tax ramifications of deals are going to be important, especially with this new interest expense limitation. I mean, I think you'll see more deals being done with cash, and we've got all these strategic buyers now that are going to repatriate cash and from overseas, and they're going to have this money on hand. They might not have to do borrowings to do a deal. So we might see an advantage for strategic buyers over the old general PE type of buyers. So there could be some real activity going on in the M&A market. I think there will be, and I think tax will have a much bigger seat at the table than they used to.
Well, I don't know that I could agree more with you there, Janet. And I'm really like the idea of the tax guys getting that bigger seat at the table. What I think traditionally has happened from an M&A perspective is the tax model is kind of that last hour in the day when we're determining whether or not we're going to go through with this deal. I think that it is such an impactful piece to the puzzle. And if you squeeze the balloon here, it's going to pop up somewhere else. I stress the point that I think strategic modeling that includes the tax impacts of how the deal gets accomplished in each step.
Going back to something that was mentioned earlier, and about you're looking at this tax rate cut, but what it's going to mean at a corporate level, what that means across the various states. The way I see it, not every state will adopt the federal tax provisions, and weighing the trade-offs between reduced tax revenues and attracting corporate players to their specific jurisdictions. Jim, what adjustments do you think they'll really make around that?
Hannes, you hit the nail right on the head there. Janet mentioned it, and I know everyone is aware that it's out there. But wow, this is a biggie. This is a biggie. State conformity or lack thereof is going to be huge with what the impact will have on companies when all the dust settles. Watching this unfold is quite the nail biter for many of my clients, because depending on what a state that you have a huge presence in and a huge liability in, that could only get bigger, or in a situation where you don't have a huge liability and all of a sudden, based on a tweak here or a tweak there, your liability grows significantly. I mean, this has state windfall written all over it. And in case you haven't been watching, states are broke. Whether it's a loss of federal funding or it's huge pension liabilities, states are operating in the red. So this could be a huge play for states. If you look at some of the biggies that we've already talked about, you look at full expensing. Yeah, the states don't care for that one very much. So that's likely to be a definite adjustment that you're going to see in a majority of the states, if I were predicting. Dividends received varies widely amongst the states, so that'll play out on its own. The interesting one, I just realized, pardon that pun, the interesting one is in fact the interest limitation. States really like the idea of limiting the interest that you can deduct, but the taxpayers really need to pay attention to this one, because they need to watch how states implement this. Because at the federal level, it's one thing to disallow interest, but states who have varying filing methods could limit the interest deduction at an entity level or some different kind of level. And this could make a huge, huge dollar difference in terms of what the taxes are in an atom up environment, in a separate state environment, to all the play, because there's a lot of debt that occurs not just to the outside, but internally in and around a corporate group.
I mean, you talked about some of those challenges there that for the state. You've all talked about some of the challenges for the companies within each one of your sectors. So I'm going to give each of you 30 seconds to tell us what part of the tax code offers the biggest growth or transformation opportunity within your sector. And I'm going to crack the whip on this one and keep you really close to those 30 seconds. So, Brian, starting with you, tell us what provision would generate the most growth opportunities for tech companies. Away you go.
So I'm going to take the 100% dividends received deduction and repatriation provision. So again, we're going to unlock, what was cited as possibly trillions of dollars of cash, and having that available and accessible to our U.S. multinationals who can then deploy that through M&A and R&D. So I think that is the provision I would point to, citing this huge opportunity to take advances with M&A.
Brilliant. Thanks, Brian. Janet, over to you. What element of the tax reform presents the biggest growth opportunities in media and entertainment companies? And your clock starts now.
Well, I hate to be a copycat, but I have to say having the ability to tap into all that overseas cash and get it back here and use it for R&D. And as I said before, really create some additional original content. I mean, consumers, we finally figured out how to get to the consumer through technology. And now we've got this, monster that's been created, and we've got to feed the monster 24/7. And the monster wants everything, and they want original stuff. So I think using that money to create new content continually, and more cooler content and interactive content and accessible anywhere, anytime, I think that's what these media companies need to do with that money. And I think that will be a differentiator for them. And the people that own that will last, and the people that don't will go away quickly.
Janet, I have to say you ran long there, but because you're talking about cool content, I just got so excited about what could be coming down the pipe for me to consume. So I'll let you go. Okay. Jim, I'm going to give you your 30 seconds unless you can excite me even more about what it means for telco companies with a tax code.
Yeah, I can't touch that. She's got media. That's the easy one. My biggie, because of the CapEx that's involved in building out the networks, is immediate expensing of asset purchases. I mean, that is a game changer. And the impact that it's going to have is really related to the timing. It's the timing of right now, the big thing. There's network maintenance that goes on regularly, but 5G is huge. The move to 5G is exponential as far as the capabilities to enhance all of those cool gadgets that Janet's talking about. She needs 5G. And the cost to implement that is exceptionally high. Being able to expense that is going to have companies work that much faster to get in there. The sooner we get 5G, the sooner all that cool stuff's going to work even better.
Thanks, Jim. And I know you played upon the fact that I'm always excited with cool gadgets to get you a few extra seconds there. So nice touch on that one. But no, thank you to all of you for kind of painting a picture of what that real upside is. Let's all take a step back and look at that slightly bigger picture, even beyond what we talked about earlier of some of those M&A opportunities around R&D. And when we're thinking about it in a broad sense, a lot of people are wondering if the TMT industry, frankly, is going to sink or swim in the wake of these changes. And I'd love to hear from each of you on what your overall outlook is for each one of your industry sectors.
So I'll start on technology. I'd say the future is very bright as companies look to move into new technologies across industries, by the way, but looking to put in place digital transformation, put in AI and blockchain and other transformative technologies. They're going to be looking to the tech industry to provide those products and services. And so I think reform gives those companies a platform to drive change throughout their organization. Jim talked about 100% bonus depreciation. That'll help our clients in the tech industry as the suppliers of those products. So I think that, again, the future is very bright.
And, from my perspective, since I went long last time, I'll go short here. I think media companies have been treading water a bit in recent years, and I don't think they're going to be treading water anymore. I think they're going to be swimming, and not just swimming, but swimming laps. I think that this cash is going to create a lot of great development and exciting things for the industry. And I think we're going to see some foreign companies that were, hesitant to come into the U.S. They wanted our customers, but they didn't want to have a presence here. I think we're going to see some of them coming into our U.S. soil. And so, we're going to see more investment in the U.S. And I think the media companies are going to really be beneficiaries of this new tax reform, I have to say.
From my perspective, I don't know that I could be more bullish. TM&T are literally changing the world and definitely making it smaller. If I think of every industry out there, every single one of them, I think of them as a spoke on a wheel. TMT is the hub of how that wheel goes round. And I think for all of the things that both Janet and Brian spoke of, I think TMT is huge go forward. Now, my only caveat to my wildly bullish outlook is around categorization and how we keep score, which is always the way. How tech, media, or telecom companies exist today is likely to be very different in the not so distant future as we get into their business, they get into our business, other industries get into our business, and it starts to be confused of what tech is, of what media is, of what telecom is. So I want to throw that proviso out there that as convergence lays down and changes our perspective of what these various industries are, could change the overall scorekeeping. But overall, TM&T is rock solid way into the future.
I mean, this is great stuff. And it sounds like, yes, there's little doubt that digesting these tax cuts, the Jobs Act, it's going to be challenging. State level, enterprise level, but it's clearly full of potential. I mean, these provisions are complex and the implications for tech, media and telecom companies are clearly far reaching. That positive outlook is really exciting for everybody in the corporate space, but all of us as consumers.
So thank you, Brian Pinto, Janet Moran and Jim Nason for joining me today to discuss these implications and sharing valuable insights for businesses as they start preparing for the new tax law. Brian, Janet, Jim, thanks for being on the show.
Thank you.
Thank you.
So thanks for tuning into this week's episode of User Friendly. Tune back in 2 weeks for another exciting topic. See you then.